Hi, everybody. My name's Kevin Gormley with Leading Edge Financial Planning, one of the lead planners over here. And something really unique and kind of strange has happened with 401k in 2026. If you've already heard about it, then you know the catch up has to go into the Roth section of the 401k, and you know the dynamics of how to get that catch up, make sure it gets in there. Then this video is not for you. But if you're unaware of some of the changes that have happened and some of the nuance of money in the 401k, it's a little bit weird. So anyway, we want to make sure everyone maximizes the amount of money they want to get in their 401k. If you're over 50, you can do a catch up, but the catch up has to be Roth. And because of all of that, that's changed the dynamic of how money is going into the plans, at least for 2026. So I'm going to pull up a schematic that I've made of the race to 72. So it's all about the race to 72, $72,000. So when we look, the pilot, what can the pilot control in the 401k, PRAP, or whatever? The pilot can control the first $24,500. And the pilot must, and I do say must in this case, not may or shall or any of those other words, but must beat the 24,500, must get in before the company gets to $47,500, because this goes to 72,000. And if the company wins the race, this bonus catch up, this $8,000 here, this right here, you will not be able to get any money into the catch up. And so by getting to 24,000 before the 47,500 happens, then money will start to go in. And at Southwestern United, it will start to go in there after that money goes into and let's just call this the regular 401k. The regular 401k, you can put it in pre-tax, you can put it in Roth. Non-elective contribution usually comes in pre-tax. I think all the airlines now could change that to Roth as well, but the catch-up now must be Roth. That's what the law says. The IRS came out and said you don't actually have to follow the law really late last year, but we think everyone is. So what does this mean for a pilot? Well, it means if you're a captain and earning a good amount of money, let's say $400,000. With most of the airlines, we think if you get more than 10% in, again, it could be a combination of pre-tax and Roth, you'll have the opportunity to put the money in. For lower earning pilots, but ones that, again, the NEC will still $18,000 per $100,000 or 18% will still knock them out. I think 13% is the number that we're targeting. I think there was one case where it might be 14%, but 13% really is the lucky number here to be able to beat the NEC and give you the opportunity. So let me show you what this looks like visually on a calculator. So Andy's built these calculators for all the different airlines. This is the one for Southwest Airlines. Instead of pay rate being per hour, it's per trip. And then the TFP is the trips for pay per month. And but you can just the other airlines all have hourly. So let's say that this captain here, $350 pay rate, 95 trips for pay, and so it makes 399,000. And this pilot decides to do 10%. 10% is the number we said for higher earning pilots. And so this right here, this orange, which is right here, the pilot deferral, you can see that it stops in August. So August is the month that the pilot deferral stops. But then what kicks in at that point is the pilot catch up. So the pilot then catches up for 3 months, and then the non-elective company contribution continues. It continues through August. And then this purple would be the spill. So in the case of the other airlines, such as Delta and American, this money would spill maybe into the market-based cash balance plan, maybe spill back to cash. But here's the big thing. I mean, you can get $80,000 a year now going forward or more. And the catch-up is either $8,000 or it could even be $11,250 for those in the 60 range. And so $80,000, terrific amount of money. We hope you do it. The final thing I have is just for Southwest pilots, and I'm not sure that this is the same for other airlines. If someone knows, just say, yes, it's the same, Kevin. I would really appreciate that. So for Southwest, they put in a new switch here on the bottom. But before we get to that, this is the regular 401k. So you could either do pre-tax or you can do Roth. And again, you got to get to 24,500. Somewhere between 10 and 13% will get you there and beat the company NEC to your 401k, and then allow you to do the catch-up deferral. And the catch-up deferral is in Roth. And this is really the big takeaway. You need to be able to opt in. It says opt in, opt out. You don't really click any buttons, but to be able to opt in, you must put a number here. And so I would just, if you put 10% up here, I would just put 10% down here as well. You'll maximize it. You won't wake up in November of this year and say, what happened? I can't put money in the catch-up. What happened? It's because you must, number one, you must beat the company in getting the money in. And then number two, for Southwest Airlines, you must put a percentage in on the workplace 401k website. Thank you all so much for watching. If you have any questions, comments, if anything I misspoke, please let me know. Thanks.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for decisions based on such information, and it should not be relied on as such.